Okay, guys, now it is time to look at some examples involving debits and credits and how we actually journalize transactions. Okay. First, what you're going to notice here is I pulled in our little debit and credit cheat sheet. And the only thing that's missing here is the withdrawals or dividends. And what you have to remember is withdrawals and dividends behave the same way as expenses. Okay. So as a quick summary, okay, for asset accounts, we debit them to increase them, we credit to decrease them. For both liabilities and equity, a debit will decrease the account and a credit will increase the account. Okay, now we have three items that technically flow into equity. Okay, and that's going to explain the behavior of the three items that flow into equity. All right, revenues, of course, increase equity. So they behave exactly like equity. We increase them with a credit and decrease them with a debit. Okay, expenses and dividends or withdrawals have the opposite effect on equity. Expenses or dividends cause equity to decrease. Because they cause equity to decrease, they behave in exactly the opposite way. We debit them to increase them, and we credit them to decrease them, okay? All right, so now that we have a pretty good understanding of how debits and credits work, let's look at some transactions. Now, the first thing that I want to point out is the format of journal entries, and this is going to be significant, especially when you're entering your journal entries into the system. This is the format. This is the standard format for journal entries. You always start with the debit, then you move to the credit. If you're writing them out on paper, the credit will always be indented. And then there's normally an explanation down here. They may or may not require that. On the specific homework exercise, it should let you know whether an explanation is required. But the debits always go in the left-hand column, and the credits always go in the right-hand column. Okay, so first you record your debit, then you record your credit. Okay, so without further ado, let's look at some transactions. All right, on October 1st, we're looking here. This is the Quantum Clinic. Okay, this is our example. All right, so the clinic issued 5,000 additional shares of capital stock to Doctor. We have to assume that this is the owner or one of the owners of the business for $72 a share. Okay, so we take 72 per share times 5,000. That gives us $360,000. Okay, two things happen here. All right, the doctor gave the business $360,000 in cash. That means cash needs to go up. Well, cash is an asset account. So in order to make cash go up, we need to post a debit. So we debit cash $360,000. Okay, capital stock also increased because we now have $360,000 of capital stock outstanding. Dr. Sagas here is holding it. Okay, capital stock is an equity account. So in order to make capital stock go up by $360,000, we have to credit capital stock $360,000. And remember, within each journal entry, our debits and credits must be equal within the entry. Okay, so in this case, we debit cash $360,000. That makes cash go up. We debit capital stock $360,000. That makes capital stock go up. Okay, now I really like the next example, and that's why I chose this problem specifically to review, because it's a perfect example of a journal entry that involves more than two accounts, but the debits and credits are still equal. So let's see what went on October the 4th. On October the 4th, the clinic purchased some diagnostic equipment. The equipment cost $300,000. They paid $120,000 in cash, and they issued a note payable for the remainder, which would be the balance of $180,000. All right, so we have a few things going on here. First thing, we need to record that asset. Diagnostic equipment is an asset. Remember, to make an asset go up, we need to debit. So we're going to debit diagnostic equipment, $300,000. Now we have a couple of other things that happened. First, we paid $120,000. Okay. Remember, when we see that word paid, we know that our cash balance is going down. Cash is also an asset. All right. To make cash go down, we credit it. So we credit cash $120,000. All right. Notes payable is a liability. All right. We need to increase our liabilities because we now owe that $180,000. To increase the liability, we need to post a credit. All right. So our entry is a debit to equipment for $300,000, a credit to cash for $120,000, which decreases cash, a credit to notes payable for $180,000, which increases notes payable. And our description here, we purchased equipment, paid part in cash, the remainder on a note. All right, so let's see what happens on the 12th. All right, on the 12th, we're going to pay off some of our accounts payable. Okay, remember, accounts payable is a liability, okay? A liability carries a credit balance, okay? Because as we put things in the payable accounts and increase the account, we're recording a credit. That means in order to decrease our accounts payable, we need to post a debit, okay? Because when we pay those bills, we are decreasing our liability. We no longer owe this $7,200. We need to decrease accounts payable by $7,200. We're also going to decrease cash by $7,200. Remember, cash is an asset, okay? So we record credit to decrease cash. So our entry is debit accounts payable $7,200, credit cash $7,200. The effect is we have decreased both of these accounts because accounts payable is a liability. The debit of $7,200 decreased that account because cash is an asset. The credit of $7,200 also decreased that account. All right, so on the 19th, we're going to purchase surgical supplies for $4,800, but we're not going to pay right now. We're buying them on account. Anytime we buy on account, that is a red flag that we have an accounts payable. Surgical supplies are going to be an asset. To increase an asset, we post a debit. So we're going to debit surgical supplies for $4,800. Accounts payable is a liability. To increase accounts payable, because when we buy something on credit, we're increasing our liability. To increase our liability, we are going to record a credit. Okay, so our entry is debit surgical supplies $4,800, credit accounts payable $4,800. The effect on the accounts are surgical supplies go up by $4,800, accounts payable also goes up by $4,800. Okay, on October 25th, this is kind of the opposite. This time we are collecting on an accounts receivable, okay? An accounts receivable is an asset. It carries a debit balance. It is the opposite of an account payable. An accounts receivable represents money that our customers owe to us, okay? So when a customer pays us money that they previously owed to us, two things happen. First, cash goes up. So we debit cash for $96,000. Second thing, accounts receivable goes down because the customer no longer owes that $96,000. Both of these accounts are assets, okay? So the debit to cash increases cash. The credit to accounts receivable decreases accounts receivable. And this is an example of an account that only affects one side of the accounting equation. In this case, we did not touch liabilities or equity, and that's okay. Both of these transactions only affected assets, and our total assets did not change because we previously had $96,000 in accounts receivable. Well, we no longer have that $96,000 in accounts receivable, but now we have it in cash. So the asset balance remained unchanged. Okay. Last entry. We declared and paid a $600,000 cash dividend to stockholders. This could also be called a withdrawal. If this was a small business with one owner, we would call it a withdrawal. Dividends and withdrawals are essentially the exact same thing. Withdrawal is a term that we use when it's a small company. Dividends are the term that we'll use if it is a corporation. Okay, so just keep in mind they behave the same way. And remember, they behave exactly like expenses because they reduce our equity balance. Okay, so declared and paid a dividend. To increase the dividend account, it behaves just like an expense. To increase it, we're going to post a debit, and we are going to credit cash to make cash go down, because when we pay $600,000 to our stockholders, that money is no longer in the business. That $600,000 just left the business. So we have increased dividends by $600,000. We have decreased cash by $600,000. So again, quick summary. Journal entries. Every journal entry must affect at least 2 general ledger accounts. Okay, you must have at least 1 debit and at least 1 credit. Now, as we saw in this example here, it's possible to have more than 1 entry, but even if you have more than 1, the total debits and total credits within any given journal entry must balance.